Volatile markets have sent some investors to the sidelines. A survey of large pension funds and institutional investors by Pyramis shows Canadians investing heavyweights are concerned the frequency of big swings in the stock market will only increase. 60% of Canadian pension fund managers believe capital markets will be more vulnerable to bubbles and crashes in the future. Just 42% of U.S. pension fund managers share that concern, but a little more optimism for stabilities overseas. 91% of Asian pension fund managers believe volatility is actually decreasing. In Europe, 79% of pension fund managers expect volatility to wane. Just 10% of Canadian and 7% of U.S. pension fund managers think volatility is falling. The survey included 90 Canadian pension funds managing about 25% of all the assets under pension management in the country. Some managers have attributed part of the volatility in financial markets worldwide to the anticipated withdrawal of quantitative easing by the Federal Reserve at the end of the month. BlackRock is the world's largest money manager with more than $4.5 trillion in assets under management. Russ Koesterich is the firm's chief investment strategist. Great to have you with us.
Well, thanks for having me back, Amanda.
Well, let's start with the volatility that we've seen. Really kind of crazy rides. And at one point, in Toronto, we're in correction territory, steep declines on major U.S. markets. And then it seems as though the markets want to return to the previous levels. So give me your read on what's going on here.
I think we're having an adjustment, and it's important to put this in context. We definitely had some very volatile days the last 2 weeks, but if you look at the broader trend where equity market volatility has been for the last couple of weeks versus what was the last few years, the reality is, and for some it's a scary reality, is that the more recent past is more indicative of normal. In other words, equity market volatility in the high teens, which is what we've seen for the past month or so, that's the historical norm. I think what's happened is after a period of very easy money in the U.S., we're going back to an environment which is closer to normal. But for all of us who've enjoyed the last few years of a very quiet market, this feels like something painful, when in actuality, it's kind of what you get over the long term.
So let's talk about that kind of normal volatility and what people should do about it. I mean, you saw the differing expectations of whether it's going up or it's going down, and I guess you would say it's just going back to normal. How should people play it if they feel uncomfortable about big swings in the market? What's your recommendation?
Well, I think there are a couple of things. The first is I do think that to some extent you can't totally avoid it. This is the price of entry. Over the long term, we do think that equities look better positioned than bonds. Obviously, equities have produced better inflation-adjusted returns over the long term. And the price of that is withstanding the volatility. So you can't completely avoid it, but there are a couple of things investors do want to think about. One of which is, even though you like equities, having some hedge in the portfolio. Generally, that hedge comes out to sovereign debt, whether it's Canadian bonds or U.S. Treasuries, that generally are going to be inversely correlated or negatively correlated with stocks. They will help to dampen the volatility. The other point, which I think is very important, diversification. Global markets in general have been more volatile, but to the extent that you have a global portfolio, you've been able to dampen that portfolio or that overall volatility more than if you're very concentrated in one market. I think that's particularly true for Canadian investors, given the fact that the Canadian market is very concentrated and very dependent upon natural resources.
Yeah, and we've been talking about that. Obviously, that is a serious issue right now as we kind of contemplate low for long when it comes to oil prices. What's your thought on that whole sector? Are you pro natural resources right now, or do you look at the growth rates in the world and say maybe that cyclical bull has come to an end?
Well, clearly we're seeing a different environment, one with slower Chinese growth, a stronger dollar, and both of those are negative for most of the commodities. That said, focusing specifically on oil, I'm actually a bit more optimistic than some. I think that the levels we're seeing now, Brent in the mid-80s, that's closer to the bottom of the range than the top of the range. And the reason I believe that is, first of all, demand is not collapsing. We're still going to see, growing demand out of emerging markets for many years. And second of all, there are some supply constraints. There's a lot of supply in the world right now, but U.S. production is going to start to decelerate. And there are a number of instances in the Middle East, whether you look at Libya, whether you look at Iraq, where the existing supply is very dependent upon things remaining, if not quiet, at least stable. And we know that's perhaps a dangerous bet in the Middle East. There's a lot of vulnerable supply out there if geopolitics go the wrong way. So I'm a bit more comfortable that oil can actually move a bit higher over the next 6 to 12 months.
So then let's talk about that slow growth in the world and what that's doing to your expectations overall. As you're investing, can you find the kind of returns you once could, or are you readjusting downward in a general way?
Well, I think investors do want to have more modest expectations for their overall portfolio for a couple of reasons. One of which, obviously, with fixed income yields where they are, the bond portion of your portfolio, there's a limit to how much return it's going to generate absent falling into deflation. And while we do think equities are better positioned than bonds, most equity valuations, particularly the US and Canada, are not cheap. So that means that your starting point is a bit more modest than maybe it was 3 or 4 years ago. That said, we do see some good opportunities. In particular, I focus on US large cap. And I focus on some of the Asian markets, Japan, to some extent China and India, where I do think valuations are more modest. And places like Japan, we've seen some catalysts for those markets to re-rate to the upside. So those are some of the opportunities I'd be emphasizing in a portfolio today.
All right, then let's talk about some of the risks that you're looking at on the other side of the ledger. What do you worry about in the world right now?
Well, I think there are a couple of things. Obviously, geopolitics continues to be something that nags at investors. We've dodged a lot of bullets this year. Despite the unrest in the Middle East, oil productions remain stable, but I still think that's something to watch. If the situation changes on the ground in Iraq, or we don't have a nuclear deal with Iran, or things get worse than Libya, we could see oil prices change fairly quickly. The other risk, of course, is low inflation and perhaps outright deflation in places like Europe. This is a risk. To some extent, low inflation is good. It's positive for equity valuations. But if inflation goes too low, if it slips into deflation, that has a very negative impact on a lot of different factors. It makes it difficult for companies to raise prices. It makes debt burdens harder to pay off. And that would be a negative for the global economy. So I think looking at low inflation in Europe and other parts of the world and making sure that does not become deflation is another risk for investors.
All right, and finally, where would you place weakness in the U.S. on your list of concerns? In other words, that we won't get the growth we're hoping, and economies like Canada's really needs to see growth there.
I think the U.S. is going to actually do okay. I think it depends on your expectations. The U.S. is growing well compared to the rest of the developed world. The risk is more about getting too optimistic. So, for example, if you've got an investment thesis which is dependent upon U.S. consumers spending 3.5%, 4% more every year, then I think you're going to be disappointed. I think the U.S. can do well, but the U.S. consumer is unlikely to be the engine of global growth going forward.
All right, we've got to leave it there, Russ. We appreciate your time today.
All right. Thanks, Amanda.